Hi friends, my name is Nilesh Fadke and I help people to understand finance and accounts. By qualification, I am a chartered accountant. And in this video, we will learn mainly about the journal entries related to the items appearing in the profit and loss account also and balance sheet also. Journal entry is a technique in the accounting where each and every transaction is recorded in the books of accounts. So let's understand the journal entries with the practical example. So whenever you start any business, your first step basically to record each and every transaction of the business. Now let us assume first transaction is cash sales, that is revenue, due to which you receive cash and you record revenue in the books of accounts. Now whenever you receive cash, your cash balance on the balance sheet asset side increases by 5,000. And you record equivalent amount in the balance sheet liability side under retained earning heading as 5,000, due to which your balance sheet tallies as your asset side increases by 5,000 due to recording of the cash, and your balance sheet liability side increases by also rupees 5,000 by recording retained earnings. Retained earning is basically accumulated profit since start of the business. Now to record the journal entries, we will make use of thumb rules, which is AID, ARC, LIC, LRD, where AID stands for assets increases debit, ARC stands for assets reduces credit, LIC stands for liability increases credit, and LRD stands for liability reduces debit. Now due to this transaction, that is sales or revenue, your cash balance increases by 5,000 and your retained earning increases by 5,000. So we will record the journal entries. So cash account will be debited by 5,000. Here rule applies AID, that is assets increases debit. And to retain earning appear on the balance sheet liability side. So rule here is liability increases credit. So you will write here to retain earning, that is LIC. But instead of writing retain earning in journal entries, you will basically write the factor or item which is contributing to this retain earning, which is sales here. So instead of writing retain earning, you will write revenue here, which is basically recorded in the profit and loss account. Revenue 5,000. So being revenue booked for cash. Now second journal entry is credit sales. Sometimes you make a sales which is on credit basis. That means the customer pay later on and you don't immediately receive the cash. Instead, you record the debtors or receivables in the books of accounts on the balance sheet asset side. Now, balance sheet asset side debtors appears, and hence the rule here is AID, that is asset increases debit. AID, asset increases debit. As on balance sheet asset side, the debtors increases by 8,000 and you record the revenue. So on the balance sheet liability side under retained earning, there will be 8,000. Thus your balance sheet asset side matches with your balance sheet liability side and your balance sheet tallies. Now this 8,000 is also recorded in the revenue here, 8,000. So rule here is AID, that is debtors account debit, AID, assets increases debit, and retained earning will be credited based on LIC, that is liability increases credit. But instead of writing retained earning, you will write a factor of the profit and loss account, which is basically contributing to retained earnings. That is revenue here. So you will write revenue here as 8,000. Now on 2nd January 2025, one of the debtor or customer has returned the sales. That is, it is no more sale to the business, and hence you will reverse the entry, or as there is no more debtor, your debtor balance will reduce by let's say 2,000. Debtor basically appear on the balance sheet asset side and it is reducing due to sales return. So here you will write or make use of thumb rule of ARC, that's it, asset reduces credit. by 2000 and you will minus here as it is reducing by 2000. Now being then you will write a narration here being sales returned by customers worth rupees 2000. Now let us assume one of the party had not received, not is about going to pay to us because that party become a bankrupt. So due to which your debtors balance reduces by 1500. So you will minus here 1500. And rule here is R, that is asset reduces credit. Asset reduces credit. And at the same time, on the balance sheet liability side, your retained earning also reduces by 1500. So your balance sheet tallies. As asset side also reduces by 1500 and liability side also reduces by 1500. Now instead of writing retained earning in the journal entry, you will write the item which is contributing to this retained earning, that is bad debts. So bad debt you will write here as an expense as a 1500, which is matching with this minus 1500 retained earning. And rule here is liability reduces debit. As retained earning is a liability appears on the balance sheet liability side, it is reducing and hence liability reduces debit. Now at the end, entire debtors has paid and we received cash account of 2000 only and remaining amount we have afford them a discount. So debtors is reduced by 4500. So we will write here as 4500 and rule here is R, that is assets reduces credit. Asset reduces credit. So asset is reducing by 4500. Then cash is increasing as we have received 2000. So cash account increases by 2000. That is rule here is aid, that is asset increases debit. And retain earning reduces by 2500. So retain earning reduces by 2500. Rule is LRD, that is liability reduces debit. So minus 2500. Now this 2500 we will write here in the expense in P&L, discount expense 2500. Thus retained earning amount in balance sheet appearing in the balance sheet liability side is 5000 plus 8000 minus 2000 minus 1500 minus 2500. All these items we basically record in the profit and loss accounts. You can check here 5000, 8000 minus 2000 appearing here and 1500, 2500 were writing in this manner minus 1500 minus 2500. This is the profit, that is income minus expense is 7000. Opening balance of profit is 0 as this is the first year of operation. So retained earning, that is accumulated profit, is 7000 which we are writing on the balance sheet liability side. Thus with the help of AID, ARC, LIC and LRD, we have recorded each and every transactions of the business in the journal entry format. Thus to conclude, what we can say is that journal entries are basically a technique in accounting where each and every transaction of the business is recorded in the books of accounts. Here we will make use of thumb rule, that is AID, ARC, LIC, LRD, where AID stands for asset increases debit, ARC stands for asset reduces credit, LIC stands for liability increases credit and LRD stands for liability reduces debit. Basically, each and every transaction is routed through retained earnings where profit and loss account is affected.